The most critical thing for any business is managing their cash flow. A recent independent survey showed that 14% of businesses who were looking at international trading thought that cash flow would be a major problem. In reality, 44% of international trading businesses from the same survey found this to be a real issue. One thing you will need to take into account is the extended settlement terms that may exist in the countries in which you propose to operate. You will also have to allow an additional 3 working days to convert the currency that you receive into sterling for your bank account. You will have to consider the chasing for late payment and the potential communication problems you will have with the customer's accounts departments. The final problem could be where your customer's business fails. This will create a problem not only in cash flow terms, but also in recovery of your goods and potentially in dealing with the overseas equivalent of an administrator. Some of these issues can be resolved around planning and good credit control procedures. You should also ask your bank to advise you on how best to access your bank accounts, both currency and sterling, wherever you are in the world. Debtor insurance should also be available to help cover business failure. You can also use debt finance specialists to help manage this on your behalf and also to raise finance should that be needed. The most critical thing about exporting is to ensure that when you've sent out your goods, you get paid. There are 4 key methods. The first method is to receive payment in advance. This is the most secure method for you, but it may involve your bank having to give a guarantee in case you fail to deliver the goods. The second method is known as bills for collection. This is where you use the bank as a postbox for the documents relating to the transaction. The bank will ensure that it receives payment in exchange for the documents or an acceptance of an agreement to pay by your customer. The third method is letter of credit. This is where the bank will actually guarantee that you'll receive payment in exchange for the production of correct documentation relating to the transaction. Your customer may need to put a line of credit in place, but in exchange they will get some guarantees of the quality of the goods that you're shipping. Your final option is to use open account trading. This is the most risky one for you because it means you send the goods out and wait for the due date when the payment should be made. The method that you actually choose will depend on the trust and the relationship with your customer. There's a fair bit more to understand about these different methods, and I would recommend that you sit down with an international trade specialist to discuss further. There is also the thorny question of which currency to raise your invoices in, and what to do if you're dealing in multiple currencies. What currency should you deal in? Well, ideally it will be sterling, because then that takes away all the risk and uncertainty for you. However, your customer may not wish to deal in sterling, and this depends on your ability to negotiate. It's probably worth recommending that all currency receipts are placed into a currency account. This ensures that you retain control of the timing and therefore the rate of exchange at which the currency is converted to sterling. If you're making payments in the same currency as you're receiving, these should be done through the currency account. This is known as a natural hedge because there's no risk on converting the currency. Your only risk then is to convert the surplus currency back into sterling. In many ways it doesn't really matter what currency you use, as long as you don't leave anything to chance. For example, if you were to sell goods worth $120,000 at an exchange rate of $1.50 to the pound, you'd have a value of 80,000 sterling. But when the payment arrives, say 45 days later, what will the exchange rate be? The truth is that no one knows. If the rate is £1.55 to the pound on that day, your money has shrunk to £77,410. Whilst the rate may have moved the other way and you get a bonus, should you be taking that risk with your hard-earned income? Let's look at this another way. Let's say you had a customer 20 miles down the road who said to you, "I'll take those goods off you today, but I'll decide how much to pay you in 45 days' time." Would you accept that deal? No, probably not. So why should you take the risk of not knowing what you're going to receive in foreign currency in 45 days' time? You should look to protect your income by fixing the rate at which you'll exchange the currency when it arrives. Once you've agreed this with your bank, it's just a simple case of picking up the phone and fixing the rate. For larger and more regular transactions, there are ways that you can fix your rate of exchange as well as get the benefits of any movements in your favour. This is a form of insurance for which a premium should be paid. However, it's well worth exploring if the values and volumes are more substantial. Due to the potential for payment delays that I discussed earlier, it's probably better to consider something such as international debtor finance to assist your business to grow further. Traditional overdraft facility is not the ideal way to finance your export business. It doesn't give you the adequate control and monitoring of the working capital. The benefits of international debt finance are credit checks on customers. The finance provider will undertake credit checks on your overseas customer and provide you with credit limits within which it is safe to trade. Insurance availability for non-payment. In the event that a customer fails to pay, an insurance company will pick up the loss, leaving you to only deal with a small excess. Late payment chased by the finance providers. If the payment is late, professionally trained credit controllers, not employed by you, will chase the payment on your behalf and in the language of your customer. As you raise invoices, an advance can be made for a proportion of those invoices. This will enable you to pay wages, finance the next order through work in progress, and also to cover general overheads. This is especially important as your business starts to grow. International debtor finance does not work for all businesses, as it does depend on what you're selling and what countries and companies you're selling to. However, where it does work, it takes away much of the risk.